Hi, I'm David Stein of Money for the Rest of Us, and today I'm discussing how to be a minimalist investor. One of the movements that's really popular right now is called minimalism. Leo Babauta, in his book, The Simple Guide to a Minimalist Life, describes the principles of minimalism as: first, omit needless things; 2, identify the essential; 3, make everything count; 4, fill your life with joy; and 5, edit. But minimalism is quite old. Author and naturalist Henry David Thoreau of Walden fame taught minimalism, which he called simplicity. He wrote in a letter to H.G.O. Blake in 1848, "I do believe in simplicity. It is astonishing as well as sad how many trivial affairs even the wisest thinks he must attend to in a day. When the mathematician would solve a difficult problem, he first frees the equations of all encumbrances and reduces it to its simplest form. So simplify the problem of life, distinguish the necessary and the real, probe the earth to see where your main roots run." If we want to reduce investing to its simplest terms, what would it be? To save and earn a sufficient return on our savings to be able to pursue the activities we find most rewarding. How do we do that? Well, first, we build less complicated portfolios with the fewest number of holdings that still allow us to achieve our return objective. Barry Schwartz, in his book, The Paradox of Choice, shares a study in which researchers set up displays of jam at a gourmet store. The customers were given samples in a $1 off coupon. One display had 24 varieties of jam. The other had only 6. 30% of the people who visited the smaller jam display bought jam, while only 3% of those exposed to the largest selection purchased it. They were overwhelmed by too many choices. Too much choice can also negatively impact investing. Schwartz mentions a study conducted by Vanguard, the mutual fund company, who found that for every 10 mutual funds an employer offered in a work-sponsored retirement plan, the employee participation rate dropped by 2%, even though the employees were passing up matches as high as $5,000 per year. I often receive emails from individuals overwhelmed with the many choices of investment strategies. Should they buy individual stocks, invest in options, buy precious metals, outsource to an investment advisor, invest in index funds, or buy ETFs? We feel lost when we have too many choices because we are uncertain which is the right choice. We want to choose the option that will best meet our needs and make us happiest. When it comes to investing, we want the investment that has the greatest certainty of achieving our targeted return and where there is a minimal risk of losing money. Unfortunately, the days of achieving a safe 4 to 5% return are gone, at least for now, given how low interest rates are. Ben Bernanke, former chairman of the Federal Reserve, related how 2 of his mentors used to say, "If you never miss a plane, you're spending too much time in airports." Bernanke interpreted this to mean if you absolutely rule out any possibility of any kind of financial crisis, then you're probably reducing risk too much in terms of growth and innovation in the economy. From an investing perspective in today's climate, that airplane metaphor means if you rule out any possibility of loss in your investing, then you're probably reducing risk too much, and your portfolio will not even keep pace with inflation. That means your portfolio might seem safe, but it is actually losing money on a real or inflation-adjusted basis. In short, we have to embrace the uncertainty of investing, not knowing exactly what the outcome will be in any given year. Investors are wayfinders. We only have a general sense of what might happen. There are no guarantees. We get in trouble as investors when we forget we are wayfinders and believe the outcomes are certain, that if we just follow the correct formula, we will reach the wealth level we desire. Now, one way to reduce that overwhelming feeling that uncertainty brings and too many choices is by doing what academic researchers did. We can keep the selection of jam small. In investing, that means focusing on assets and asset allocation. Instead of trying to pick individual stocks, options, or currencies, keep your investment approach simple by allocating money among a variety of asset types, such as stocks, bonds, perhaps real estate, but focus on assets using low-cost index funds and exchange-traded funds. So here's some tools for minimalist investing. First, save more and spend less, perhaps up to 20% of your income, and if you want to retire early, even more. Diversify. Have multiple return drivers in your portfolio. In a 2000 academic paper titled Optimal versus Naive Diversification, the authors found that of the 14 allocation models they studied across 7 different data sets, that none performed consistently better than just dividing up assets equally. Why is this simple rule of thumb so effective? Because the winning and losing asset class in any given year tends to be a surprise. So we can just divide our assets evenly among different asset types and not worry so much about the perfect asset allocation. A couple of other minimalist investment tools is to keep a margin of safety, some cash, some emergency savings, and also have some pockets of independence. Have some investments away from the financial system so you're not completely in publicly traded markets. Perhaps have some gold coins, some land, or other real estate. These are things to help us become minimalist investors. Hey, if you like this video, go ahead and subscribe to my channel. If you have any questions or comments, you can leave them below. Thanks.